States, at least in the US, 30% of the population is underrepresented minority, meaning people of African, Latin, or indigenous heritage. Yeah, we get less than 3% of venture capital, right? Those are the numbers that we're trying to change, right? That 3% number. In tech and in venture, experience is a depreciating asset. That's where experience would have hurt you. And I
Right.
think that's where it hurts a lot of investors. They think
Mhm.
they've seen everything. And then it turns out that they haven't.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Ethan Monreal-Jackson with us. Ethan is a general partner at Newtype Ventures. In this episode, we talk about investment thesis at Newtype Ventures, how investing in underrepresented founders gives better returns, having internal democracy while making investment decisions, exciting portfolio companies, and a lot more. So without wasting any time, let's dive straight in. Hey Ethan, so good to have you on the VC 10X podcast. How are you doing?
Good. How about yourself, Prashant?
I'm doing great as well. So good to have you on the podcast. And like I was checking out New Type Ventures, you sent over some assets as well that I can check out your deck and stuff like that. And I love how well you have positioned the firm and how well researched it is about how you're investing. And another thing that I read was it's not just a fund; we are building a firm over here, and that's how. That shows the level of sophistication you throw into everything that you do. But we'll talk about all things there. But to start things off, can we have your story first, how you started investing?
Absolutely. So it's a long one. I apologize in advance, but I am going to try to give a quick one. I graduated from Wharton, studied finance, and I actually worked at BCG afterwards in management consulting. And so I had interned at Google. I had an itch to go into tech, but I ended up going to management consulting, which was a mistake. Thankfully, I figured that out pretty quickly and quit and joined Capital One. And at Capital One, I did everything from building underwriting models to strategy work. So I was there for about 3.5 years. And during that time, I had an itch to go into tech. And eventually, I moved out to San Francisco, joined the buy now, pay later company, Affirm, as an early employee, and got incredible experience watching that startup grow incredibly fast, being an integral part in what they did. And after that experience, I worked at an incubator, worked for, did some consulting, some advising it with other startups, and worked at another fintech before I decided to launch my own startup. And so I built a savings app. As part of getting the job at a firm, I had to learn how to code in Python. And so after my time at a firm and at a couple of other startups, I'd gotten quite proficient. I built a savings app, full stack, and we had a lot of users, a lot of sign up, a lot of growth. But when I went to go fundraise, it was incredibly difficult, very difficult. This was in 2018. And I thought to myself, look, I graduated with honors from an Ivy League. I worked at BCG. I worked at Capital One, Affirm, Google. And despite checking all the boxes, it's still really hard to fundraise, right? And so uh, when I moved to Austin, and eventually we did have a couple of venture firms interested in investing in us. My co-founder and I, after we wound down our startup, we realized that something's not right. Why aren't founders who ostensibly have all the right qualifications, founders who look like me, why aren't we getting capital? And so when I came out to Austin, I decided in 2019 that I wanted to be on the other side of the table and invest and support founders, particularly underrepresented minority founders. And so that's where my investing journey began.
Yeah. I absolutely love that story, and we always appreciate founders who are basically solving for their own itch. And this is kind of a similar story on the VC side. That okay, you're trying to fundraise and you were not able to get that funding, and you thought there is definitely something that needs to be fixed here, and then going ahead and raising a venture fund yourself. Now, I want to like ask that question: that how good or bad was your uh, fundraising experience as a VC now? Because then you were raising a fund at that point. Do you think that thing came in that okay, you are an underrepresented VC, or did it go through pretty well?
So I didn't realize that if you think it's really bad for founders to get funding, who are
Right.
underrepresented. It's
Hmm.
even worse as a fund manager. And
Hmm.
so the good news is that I'm more persistent, and I felt very strongly that we've got to figure out some way or another to get capital. So we've been fortunate. We've had our first close. We're still fundraising, but it's even harder because think about the funnel, right? There are how many underrepresented minorities who are founders? How many of them are VCs? And then how many of them are LPs, right? The folks making the decisions to invest in the funds. And so we've obviously had a lot of interest in supporting underrepresented founders, particularly during 2020 and 2021. But as you can imagine, as the economy has turned, it's natural people go to what they know. All of a sudden, the same people who were saying they wanted to support emerging diverse managers are nowhere to be found, right? The problem, I would argue, is even worse at the VC level. And so we're fortunate that we've got some great investors already who are supportive, who believe in our thesis. But I'll be honest with you, Prashant, it's even harder than I think we realized for founders. And what's even crazier is, at least in the U.S., 30% of the population is underrepresented minority, meaning people of African, Latin, or indigenous heritage. Yeah, we get less than 3% of venture capital, right? Those are the numbers that we're trying to change, right? That 3% number.
Absolutely. Yeah, and that's definitely a very evident problem. If you look at the numbers, it's pretty evident that there's definitely a gap there. And I've had this conversation with Eunice Ajim before. She's
Yep.
also an underrepresented VC running a GM Capital and focused on African continent. And she was like saying the exact same thing, that we have less underrepresented founder. That's one thing. But then if we go to the VC stage, there are lesser uh, underrepresented VCs, fund managers deploying capital, and then again the LP stage. So she was saying that okay, I've climbed that ladder from being a founder to now being a fund manager, and I for me the next step in the ladder is to one day become an LP. And she said that more and more people need to start taking that ladder and going up and up, and that's the way to go. And I love that approach. Like talking about Newtype Ventures, so I want to learn more about the name and what's new about Newtype Ventures.
So let me start with the name. So I'm a big fan of of anime, and there's a famous anime series called the Gundam series, right? It's well known among folks who enjoy anime, and within that series, there's the next evolution of humanity. They're called new types. They're people who have evolved to live in space, and the way they've evolved is that they can communicate uh, telepathically through almost like an empathy mechanism. And I thought that was a great example of what we want to be. We want to be the next evolution of VCs who can communicate with founders almost telepathically. We just understand you at a deeper level. That was what we wanted to communicate with that name. In terms of what's new for Newtype and how we approach things, it's two things. One is that we are focused on these types of founders, underrepresented minority founders. As I said, overwhelmingly they're overlooked by the traditional VCs out there. And we think it's important to take a stand and focus on these founders. The second way in which we're different is that I think, particularly amongst fund managers who are focused on diverse, let's say underrepresented, so queer founders or female founders or just different kind of founders, there's a tendency among some of these fund managers to be more focused on social impact, right? And that's not us. We are focused 100% on generating returns because we believe that if we can show that these founders are generating as good, if not better, returns than a stereotypical founder, that's going to get more people taking these founders seriously, investing their capital in them. And so, as much as we are thankful to have folks who believe in our mission, we're very clear that we're not an impact fund. We're not an ESG fund. We are a fund that thinks that the best way to generate returns is by investing in the best founders, and those founders just happen to look like the types of founders we have, if that makes sense.
Absolutely, absolutely, and you talked about that we can definitely produce. like normal VC level returns, or even higher in the case what you are targeting. And I would like to talk about your positioning, because when I was going through your deck, you said that the kind of founders that you're targeting, underrepresented founders, it's seen that they actually offer higher returns than even conventional founders. So can you throw more light on that?
Exactly. So my background again was in data science. So when I was at Capital One building models, we did a lot of data science work at a firm, and so I'm obsessed with data. I live by the mantra, trust in God, but everybody else brings the data. And I'm not just saying we should invest in these founders because it feels good. Kauffman Fellows, they've invested in numerous venture funds, supported numerous venture funds, and they published the study that showed that diverse founding teams on average generate 30% higher realized returns, not paper, actual returns, cash you're getting back, than white teams, right? And so we're starting to see more data come out that this isn't a charity. This makes sense, right? And we've seen this also among women founders as well. There's plenty of data that shows that women founders are more efficient and they're more likely to generate returns than male founders, right? And so again, we're not trying to convince people to do something out of the kindness of their heart. We're saying, hey, here's the data, and it makes a lot of sense to essentially support these folks now because it's not just the data in terms of the returns that these folks are generating. You also have to think about where demographics are going, right? We're seeing population, specifically a big population boom in the Hispanic population in the United States in the on a global level, because we do invest in Africa and Latin America as well. We're seeing a big population boom in Africa. So just from a demographic standpoint, the world is moving closer to folks who look like me, right, as opposed to folks who don't. And so you want to get ahead of that now when these founders are early, when the ecosystem is growing before there's an established foothold. That's our thesis.
Absolutely. Yeah, I love that. That you're positioning that, okay, this is not something of charity, that you're doing a good thing by investing in underrepresented founders. It's actually very logical and straight business, right? Because underrepresented founders are offering you better returns. Female founders are offering you better returns, and it's there on paper. The data shows it, right? So it's a very practical thing to do. Great. And now talking about how you're doing your investing. So when a pitch comes to you, how do you evaluate a startup? How do you what exact things or traits do you look for in founders while making the investment decision?
Well, let's start with how we evaluate deals. I don't want to give away too much information, I'll be honest, because we think that's part of what separates us from other firms is how we do diligence. But I can talk about it philosophically, right? We like to take what we call outside and inside view. So the outside view is we look at this startup, we look at the market, the environment in which they're operating. We look at how they compare to other startups' outcomes. We think that's really important because it's true. If you're playing in a market that isn't growing, that isn't urgent, that isn't winning, doesn't matter how good you are, there's only so much value to be gained. The second thing, as I said, that we care about is the inside view. So once we've done a wide survey, we then take a look at you and we say, what makes this startup unique, interesting, special? What is it about the startup that stands out? What are their insights? What are their ideas? What are their habits, so to speak, right? And once we take that outside, almost horizontal view and then inside vertical view, we take all those inputs, and that's how we get to a decision. One thing that stands out in how we do diligence is that even though I'm the only general partner, we have four members of the team. We all vote. And so we only invest if we have majority vote. And the reason we do it that way is because I think too often investment decisions are driven by your whims, your your own feelings about something. I don't care how you feel. I want data supporting that decision, right? And so when you have different people with different backgrounds getting together and they're all very smart and they've all spent time, they should all be involved in making a decision. That's something that we do that we think separates us from other venture firms, and we're happy to tell anyone who asks is instead of me being the only decision maker, it's a majority vote. So when we talk to founders, we tell them whether you're talking to an analyst or you're talking to the GP, you're going to have to convince at least the majority of us that this is worth investing in. Now, your second point on founders, what do we look for? It's cliche, but we don't invest in jerks. We don't, because at the early stage, you have to be able to work with the founder. And so if you don't have a relationship with the founder, if you can't connect with them, it doesn't make sense. Now that I'm going to be honest with you, Prashad, that doesn't mean jerks can't win. We know that jerks can do very well, but if you can't, if you don't have some type of chemistry and empathy with them, if you don't have a relationship with even a strong personality, let's say they're not jerks, they just have a very strong personality, then it's not going to matter if you invested, because you're not going to be part of that journey. You won't be able to invest more in the future, and it's not going to build your reputation, right? We also don't invest in founders who aren't transparent. I think there's been a lot of, I think, bad information given out to founders in the last couple of years about withholding information, about being coy. The irony is that the strongest startups are always willing to share information, right? They don't share everything, but they're willing to share more than I would argue weaker startups are willing to share, right? We had one startup in particular, they had a really massive revenue drop in one of their quarters, and we asked them point blank what happened, and they had a fantastic explanation for it. They didn't blink, they didn't hide the data. They were completely upfront about what happened and how they bounced back, and that stood out to us versus some founders who have great numbers but then they can't explain to you what happened, what their thinking was, why did that occur. That's a huge red flag. And then finally, this is more tactical, but I have found that founders who give consistent updates are usually better founders. Too many founders don't update their investors. Their updates are haphazard, they're inconsistent. I think that says something about how a founder or a founding team works. If they can consistently give updates, if they can consistently communicate, that says something about how on top of the business they are versus founders who kind of tell you on an ad hoc basis.
Right, absolutely. And you said you have four GPs on your team. Is that correct?
I'm the only GP. We have four members at four folks at Newtype Ventures, but I'm the only GP.
Okay, so there are in total four people, including yourself, right?
Yep,
Got it. So in case there's a vote and it's 2-2 split, then in that case, what do you do?
we don't invest,
Oh, okay. Got it.
and that's why I said we're very different in that oftentimes you have a hierarchy, right?
Mm-hmm.
It's like,
Mm-hmm.
okay, if this person's the GP and he or she
Mm-hmm.
doesn't want to invest, then we're not going to invest. I'm
Right.
perfectly fine being the only vote who says no, and then the rest of the team says yes. Then we're still
Mm-hmm.
going to invest, right? Because it's like, what's the point of bringing on great people if we've
Mm-hmm.
all looked at it differently, if we've all absorbed the data, if we've all asked the questions? What's the point then of having your
Mm-hmm.
input if you're not
Mm-hmm.
even going to be able to have any real
Right.
decision making authority, right?
Mm-hmm.
Like I hated that. I hated working at a place and they'd have me spend months on a project, and then at the
Mm-hmm.
end of the day it's out of my hands when I'm the person who has the most information to
Mm-hmm.
make the best decision. And so that is something that we do very differently from other venture firms where you'll have one GP, a bunch of interns working for free or something, and it's just that GP's gut that makes decisions. That's not how we do things.
Absolutely. Totally love that approach. And that's not very frequent to find that kind of a setup in today's world, even in startups. Like the democracy is not that much there, right? It's the one at the top calling the shots mostly. But then, like one counter argument can be that the ones at the top are actually the ones who have had the most experience, who have seen, who have made the most mistakes. So in that case, they probably know what might or might not work out than the folks who are starting out. So what would be your argument against that?
I actually think that's a great point. For me, though, I think tech and venture, they move too quickly, right? Like, let's say 2 years ago, what would you have been telling startups? You would have been saying the best startups raise a ton of money, they grow, 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 grow. To hell with unit economics. Now, all of a sudden, what are people telling startups? You need to worry about profitability. You need to be default alive, right? Whether or not that's true, that's what they're telling folks. This game is constantly changing, and so I tell people this in I think personally in tech and in venture, experience is a depreciating asset. It's an asset, but it's depreciating, right? Because just when you think you know something, someone comes out and completely changes the game, right? I did a lot of machine learning work at a firm, and for a long time, people thought AI had hit a limit, so to speak, right? And arguably, from a certain frame it has, right? But uh, all of a sudden now we have these amazing tools coming out of OpenAI that have opened all these use cases for AI that people weren't even considering a year ago, right? And so again, if you were a typical VC who said, "Hey, I've seen everything there is in AI, nothing's really moved the needle," you'd be missing out on all these startups that are coming out with fantastic tools that have all sorts of use cases that we haven't figured out yet, right? That's where experience would have hurt you. And I
Right.
think that's where it hurts a lot of investors. They think
Hmm.
they've seen everything, and then it turns out that they haven't.
Yeah, very interesting. Very interesting. Love that take. I know for a fact that you have previously run an angel syndicate, and now that has like sort of transitioned into a VC firm. So I would like to ask you, what's better? Is the syndicate model better, or the VC firm model better, or and what's something that you enjoy more?
I think what's great about a syndicate is that oftentimes people get excited about deals, right? And so a good example of that was when we invested in Greenwood Bank. That startup is focused on on banking for underrepresented minorities, so Black and Hispanic folks. That was an exciting deal, and so it was easy to get people excited to invest, right? The On the other hand, if you get into a really good deal that doesn't have as much excitement or as much hype, right? It's a lot harder to get folks to invest in. Another thing to consider when you're doing a syndicate is that the you can't be as risk seeking as you can be with a venture firm with a venture fund. That's probably the worst part because oftentimes angel investors don't build out portfolios the way they should. They really don't. They often make one, two, maybe even three investments in a year, right? And that's it. And so you're mindful of that when you're building out a syndicate, if you give them too many deals, if they're not properly diversifying, they're going to expect that deal that they see to be a winner, which you can't guarantee, but you have to feel more confident about that deal than you can about maybe other startups that are potentially more promising but have more risk, right? And so that's what I like about a venture fund is that you can actually build a true portfolio. You can go further on the risk curve, but at the same time you can diversify, right? The problem with a venture fund is that you now have, all these other legal obligations, you have all this administration, you have payroll, you have so many things that you have to worry about. I would say that my job, more than half of it is spent on non-investing activities. That wasn't necessarily the case when I was syndicating, right? And so, even though I think ultimately the venture fund is a better model, you can put more capital behind founders, you can spend more time supporting those founders. There's a significant trade-off because you're also spending a lot more time doing things that aren't related to founders or investing.
Absolutely agree. And would you like to mention some of your exciting portfolio companies that you've invested in?
Yeah, I will mention three of them because, like I said, we invest not just in the US, but we invest in Africa and Latin America. So in Africa, we invested in a startup called SendMe. And what's really cool about them is they're building supply chain for high quality meat. Nigeria and West Africa are some of the fastest growing populations of meat eaters in the world, right? But it's hard to get access to sanitary, high quality meat. And so SendMe is building out that supply chain. And what's interesting is that if you build out a really good cold supply chain for meat, you don't just stop there. You can build it for produce, you can build it for medicine, right? Their addressable market is massive and it's fulfilling a crucial need for a population that's growing pretty dramatically, right? In Latin America, one of our portfolio companies that we're really excited about is Talently. Talently is a marketplace for Latin American tech talent. They take software developers in Latin America, help them get better at interviewing, help them get better at English, and then they place them in companies around the world. despite some of the US headlines of tech layoffs, engineering talent is still at a premium. There's a massive shortage for folks who can write code. And so the more we can help bridge that, right? The more we can build, we can innovate. And that's what Talently is doing. And we see it because they're growing like crazy. And we're very, very proud of the founder, Domenica. She's a force, right? And so we're excited about that deal. And then in the US, we invested in a startup called Kudos that's building a smart digital wallet for consumers. And so people are worried about inflation, they're worried about savings, right? Well, what Kudos does is they help you pick the right credit card and find the right deals to save the most amount of money for you, right? But the thing that they do is they have access to all of your credit cards. So they can tell you at any point, this is the best credit card, this is the best deal for you. And I don't know about you, Prashant, but I've never met anyone who said, I don't want to save more money. I don't want to deal. I want to pay the worst price, right? And so what's interesting about that deal is that they are working on a problem that is evergreen. People always want to save. And the founders are two of the best product managers that we've met. They're incredible recruiters of talent. And so we're excited about them as well.
Absolutely. Those were three very exciting startups. And moving on to my last main question before we move on to the rapid fire round. This one is about what's your biggest learning investing over the years, first as a syndicate lead and now as a VC fund manager?
I need to be careful because this is kind of giving away things, but I do think the biggest secret I've learned is that there's a lot more data that you can use in investing, right? People talk all the time about its gut, it's the founder, but the reality is what makes up your gut, right? It's usually data, and there's a lot of really good early signals that can tell you that there's something special about this startup. And so I'll admit when we first started investing, when I first started investing, I thought, is it just me and how I feel about a founder and what I see? And I quickly realized that, you know, I can't necessarily tell you, Prashant, that I can pick unicorns, but I can tell you oftentimes, hey, this startup isn't going anywhere or this doesn't make sense, right? Because of the data that I'm seeing on how quickly they're moving, the market that they're working in, their pace of iteration, of building, things of that nature. And that's something that I think is surprising to a lot of first time investors that there's more science than art. There's still plenty of art in investing, but there's also a lot of science.
Absolutely, I agree to that. And now moving on to our rapid fire round, wherein I'll ask you five quick questions about the fund, and you have to give five quick answers. Sounds good.
Works with me.
All right. So the first one goes: what are the sectors and regions you invest in?
We are sector agnostic and we invest in US, Africa, and Latin America.
Great. What's the typical stage of investment?
Seed stage,
And what's the typical check size?
100 to 500K US dollars.
Where can founders pitch you?
On our website, they can apply and we'll respond to them.
Great. And where can our listeners follow you?
I don't think they can follow me anywhere. I think other than LinkedIn. Real G's move in silence, which is why I don't have social media.
Love it. Love it. Great. I'll put your LinkedIn link there in the show notes and your website link as well so that founders can reach out. Thank you so much for doing this, Ithan, and love talking to you. Love your approach to investing. And I'm very, very hopeful that you're going to back some of the biggest winners in the underrepresented community. And because you have this knack for data and this different approach to investing. So, all the best to you and happy investing.
I appreciate it, Prashant. Same to you.
Thank you.